We're actually not going to bring you the headlines. We're going to go straight into the markets today because we're going to reflect on what happened in the budget following that significant reaction we saw to Labour's first budget in 14 years. A sell-off in government bonds had intensified yesterday following the Chancellor Rachel Reeves announcing an extra £28 billion a year in borrowing. The Office for Budget Responsibility called it one of the largest fiscal loosenings of any fiscal recent event in decades. Let's have a look at some of the details on this. The 10-year gilt yield peaked at over 4.5% yesterday as anxious investors dumped bonds. Sales of government debt were forecast to reach $300 billion in the current fiscal year, up from the previous estimate of $278 billion. And that saw the pound fall 0.8% against the dollar to $1.28, its lowest in more than 2 months. And if we have a look at where the pound currently is, as I say, it's recovered a little bit of ground there, up against the dollar and the euro this morning. Well, let's bring in our economics and business correspondent, Paul Kelso, who's in the newsroom with me. Paul, good morning to you. Just first of all, what has gone on here in the last 24 hours or so, and how concerned should we be?
So we've seen the gilt markets, which essentially where the government borrows from. We talk about government borrowing. They sell bonds known as gilts. They used to have a gold edge, literally, treasury paper. And the yields we're talking about here, these percentages, are effectively the cost to the government of borrowing. And we saw them staying pretty flat during Rachel Reeves' budget speech. But yesterday we did see a significant increase in the 10-year gilt, which is the benchmark. There are lots of different maturities for how long your bond might last. We did see them rise to a peak in a year, up to of just over 4.5%, the highest since late May, the highest in a year, and clearly driven by the budget. And there seems to be two things at play here. One is the markets have looked at the borrowing plans, £100 billion of borrowing, big tax rises we know, but most of the spending increase, at least half of the spending increases in next year are going to be coming from borrowing. Markets have thought the government's going to have to borrow more, so the cost of that borrowing, they feel the risk premium went up slightly. There's also another thing going on. This is quite an inflationary budget, potentially. Lots of money being pumped into the system. If there's more inflation, that might make the Bank of England hold off on its interest rate cuts. An expectation they would come frequently at quarter-point intervals from now. That isn't the case. The markets right now, I should say, there was a little increase this morning, but they are below where they were yesterday. 4.44% is the gilt yield. So they do appear this morning to have stabilised.
OK, Paul, thank you very much indeed for that. Let's speak to Daniela Hawthorne, who's the senior market analyst at Capital.com and joins me now. Very good morning to you, Daniela. Just first of all, on that point, we've heard lots of a range of views today about how concerned we should be about the market reaction. What's your initial reaction?
I think we were listening there from Paul, and he was spot on there. We've got two things going on. One is increased borrowing from the government, which does increase market jitters. And we've also got that impact on what that will mean for inflation and what that means for the Bank of England. So we've seen this increase in borrowing costs in the UK. As he was saying, 10-year yields up at one-year highs, but also the spread between the UK gilts and the German Bund, which is the benchmark for risk, actually at 2-year highs, close to where they were 2 years ago when we saw the budget meltdown. So there's definitely some risk going on. It's just a case of how do we manage this? What does this mean for interest rates? And we're definitely seeing concern here, a little bit of trouble, but they have come down a little bit today.
They have, but there is still also a kind of waiting game, if you like, when it comes to particularly the Bank of England next week.
Yeah, and I think something to point out as well, it's not in isolation just in the UK. It's happening in the US, it's happening in Europe. We're seeing yields rise across the board. So there's definitely trouble in the market. And the Bank of England now actually expected to cut the least out of the Fed and the ECB as well. So definitely investors now concerned as to what inflation is going to mean and how much we're going to be able to cut.
Really fascinating also listening to different reaction we've had. Barclays today largely welcoming this budget, saying it was finely balanced, but it got the balance right. And then you have Moody's, the rated agency, this morning, though, saying that it provides an additional challenge because the government are borrowing so much.
Yeah, look, some people think it's good. Some people think the budget was balanced. It's helping the economy. Growth is expected to grow. The OBR forecasts growth in the next 5 years, but inflation is also expected to go up. So it's just a case of how finely balanced can this be in the future, but also what's happening with earnings, what's happening with companies. This is expected to increase the labor costs for companies because a lot of these tax increases in these measures are going to affect businesses. The whole point from Labour was to commit to not increase the costs for employees, but ultimately this is going to affect someone, and that's affecting businesses. So how is that going to affect earnings? How is that going to affect inflation? So as you say, look, it's not as bad as it was 2 years ago. I think a lot of the measures delivered were expected. It's just a case of how much is the government going to be able to borrow and keep those borrowing costs to a point where it's not going to affect the economy, it's not going to affect businesses, it's not going to affect the Bank of England's plan over the next 2-3 years. As I said, the Bank of England now expected to cut less in the next year than the Federal Reserve, than the ECB. And a lot of that, not only on the budget, I have to say, as I said, we've seen yields rising across the board, rising since mid-September, but the budget has accelerated that, if you want, and markets now slightly concerned about what does that mean for the Bank of England? And I think we've got a lot of important data coming, maybe not so much in Europe, but we've got important data in the US today. We've also got the US elections next week and the Federal Reserve and Bank of England meeting. And bond markets are very, very closely tied. So we could see yields move again this afternoon. Just under an hour, we get the jobs data in the US. Are we going to see a big beat there? What does that mean for the Federal Reserve? What does that mean for yields in general? Yeah. So there's definitely a lot going on in the market, and we're definitely seeing jitters. But it's just a case of how we'll be able to handle this and these expectations going forward.
Lots of moving parts, as you say, Daniela. Just very quickly and finally on this, away from the macro situation, we look at kind of what it means for many people watching at home, and Labour effectively saying that this is going to have an effect on working people, and that also, by the end of this decade, we might individually not be any better off in terms of actual living standards.
Well, I think, look, that's always going to be a case at some point, especially when you've got government borrowing so high, 90% of GDP. There's always going to have to be measures that affect the end consumer. Even if you try and cover it and try to make it all about let's increase taxes for the high earners, let's increase taxes for the big corporations. They were trying to sell that they were helping small businesses and the retail sector and the high street sector. But effectively, we're all going to see the effect of this, and it is going to increase mortgages indirectly, especially if we see rates having to hold at higher levels because of that increase in inflationary pressure. So we are going to feel the pinch at some point, even if on paper or the initial reaction is that it's not going to affect employees. We are all going to see it, and it's just a case of how we're able to balance this. But I think government borrowing is a key for this, especially if markets continue to be concerned. How are these spreads with German bonds going to evolve? How are these spreads with US bonds going to evolve? And effectively, where do we go from here? We're still unsure with central banks. We're still unsure where the terminal rate is going to be for a lot of these economies. Okay. Terminal rates now priced up higher in the US as well because of the Trump trade, because of improving economic data. So it's just a case of how do we balance that? Okay. And I think Labour was trying to sell that, but I don't think they've hit home on it just yet.
Well, we shall see, as you say, a lot happening over the coming days and weeks. Daniel, you'll be across it. We will as well. Daniela there from capital.com. And don't forget, you can keep up to date with what is happening in the markets this afternoon, particularly when things start moving in the US. On our Money blog, just scan the QR code that's on your screen right now. Now, the trend of homegrown tech firms leaving the country to float elsewhere in pursuit of higher valuations has dogged many chancellors. A notable example was when Arm Holdings, the Cambridge-based chip company, that chose to float in New York last year rather than here in the UK. And one business owner here is also facing the same choice. Has the budget convinced him to break the trend and to choose to IPO in London or in New York? Well, speak to that business owner, Paul Taylor. He's the founder and chief executive of Thought Machine. That's a digital banking platform, and he joins me now in London. Before we ask you that very key and obvious question, Paul, we've been talking a lot about the budget, unsurprisingly. What's your impression of what Rachel Reeves has done this week?
Yes, well, I'm sure I talk for many people in the tech industry that the reaction's very negative, negative on multiple fronts. So I guess I would split it into two bits. So there are the specifics and then the general nature. So on the specifics, clearly the national insurance raise is a really high wage bill for Thought Machine in particular. That's £80,000 that we have not got, any capacity to spend. Unexpected. And then the second thing is we're a tech business, we're growing. Stock options are a very big part of how we remunerate our staff, and the capital gains and that's gone from 20 to 24%. Now, I understand the argument about capital gains when people are making a lot of money regularly from capital gains, but for many people who work in tech companies, this will only happen a few times in their lifetime where they get the ability to sell their shares. And that is a reward for a huge level of risk over multiple years, and often when they're not being paid the regular market rate. So that is a huge part of it, and I would be very, very against any further changes in capital gains.
And we were talking about your company. Is this budget potentially going to have an impact on that decision about where you decide to go in the months and years to come?
Well, yes and no. So Thought Machine's an international company. It is headquartered in London. It was founded here. We have offices in New York. We have offices in Singapore. So, but we are always looking at where we should put our staff and where we should do that internationally. We are going to open a second engineering office in Eastern Europe next year or the year after. And that was going to be a small operation. But when you think about, anti-business taxes being added onto this, the relative benefits of having software engineers in London versus software engineers in Eastern Europe, it tips the scales. And also, I was going to say, it's not just the specifics. I mean, the specifics of this budget, could be born in time. We will find a way. But if this is the start of, there's another 4 budgets to go in this Labour government. And if this is the start of this, it's the worry for the future. So that's about the staff location. When it comes to listing, it is a wide variety of factors. So some are genuinely outside the government's control. And as we know, the American markets just have deeper liquidity, a greater investor base. But also, one of the things that really makes companies want to list in the UK is when you think the government has got your back. And I'll give you a good example. So when Silicon Valley Bank imploded last year, the government's response and the Treasury's response was incredibly good. We were through to number 11 straight away. We're through to the Bank of England, and the network of community and tech entrepreneurs mattered. So key consideration is whether you think the government in the jurisdiction you're going to list has your back. And that means, in general, are they pro-business or against business?
OK, well, we will see what happens, what decision you make. Have you made a decision? Is it New York or London?
No, our mind is open, and it's not going to be for a few years yet. But we talk to the people at London Stock Exchange all the time. They're very keen, but the American markets are very attractive as well.
OK, Paul, thank you very much indeed for your time. That's Paul Taylor there, the founder and chief executive of the Thought Machine.
Thank you.
Now, in just 5 days, Americans go to the polls in what is one of the most eagerly anticipated and potentially consequential election in years. The economy is, unsurprisingly, the number one issue for most voters. And despite booming growth and near record employment, many have blamed the Biden presidency for inflation. So what difference could a second Trump term make domestically? And could it damage the global economy? Joining now is Rachel Reeves. He's a former advisor to Bill Clinton and a political strategist. Very good morning to you, Morris. Let's talk about this suggestion that the economy is the number one issue. You worked for Bill Clinton. I think it was, I can't remember who it was, but someone around the Clinton presidency said it's all about the economy. Stupid. Do you think it still is, even in 2024?
It's always about the economy. When you go to the polls, you're always thinking, will this candidate make my life better? Or will this candidate make my children's lives better? So no matter what happens, it's always about economic issues. This is where the Biden folks struggle. Statistic-wise, number-wise, they're doing fantastic. What they haven't been able to do is communicate to the American public that they are doing better. But when you have groceries and you go and buy eggs and you use $5 one day and $10 the next, you don't feel it. So it's definitely about the economy, and it certainly will be on the voters' minds.
Morris, do you think America, because it's kind of strange for outsiders like me who look at the US economy, look at our economy, look at Germany's economy, Do you think Americans, and they look at inflation and go, well, it is happening and it has happened elsewhere in the world. All developed countries have seen massive increases in prices. This isn't linked to one political party or to one particular politician.
Well, unfortunately, voters don't know much about Georgia unless you're talking about Georgia, Atlanta, Georgia, when you're walking in the voter booth, or you're talking about London, Kentucky. Most people really focus on their pocketbook issues, their purse issues. So understanding inflations, it really doesn't matter. When you're a family of four, you're a single mother, what you care about is, can you make ends meet? Do you have enough at the end of the month to pay your bills and to make sure your kids are safe? That's really what voters care about. They don't really care about what's happening from a international perspective. As Tip O'Neill said, all politics are local. So what the president of the United States or a candidate for president of the United States has to always communicate those local issues to the voters first and foremost. And the economy always will be number one.
Okay, and let's talk about the choice then, and particularly about Donald Trump. He's got some pretty radical possible plans, and particularly around tariffs on goods. What impact could that have, not just on the United States, but indeed for the rest of us as well?
Well, there's two things. Number one, tariffs fundamentally are passed on to the consumers, right? Most people don't understand this. They just hear the rhetoric. But if you are charging more for goods, products, and services, then the consumers will pay more. So that's number one. The consumers will pay more. Secondarily to that is how you support your allies. If you're putting across the board tax on things coming from Germany or the UK or France, then they're going to do the exact same thing. So you then have a trade war. So from an American standpoint, the consumers will pay more, full stop. From an international trade standpoint, there will be a trade war, and that only leads to higher prices, and it also leads to reconsidering of these strong ties long term. So tariffs never work fundamentally. You have to make excellent products and services that people want to buy.
Okay, Maurice, it's fascinating. We're all going to be watching next Tuesday. Thank you so much indeed, Maurice Reed there, joining us from Athens. You're watching Business Live on Sky. Well, let's look at the markets. I'm going to start here in London, where the FTSE 100 has opened up this morning around 0.6%. That follows a 3-day sell-off that sent the index to its lowest in 3 months. Look at Ricketts, the consumer goods firm. They're enjoying a relief rally off the back of some of the latest rulings they have around disease associated with their baby formula, but they've, as I say, rebounded somewhat. On the continent, as you can see, also blue across the board there. They ended up higher than expected and seem to be doing pretty well, not least of all taking into some of the troubles that the Eurozone has seen recently. And on the United States, we're all waiting for those job figures a little later on this afternoon. The Asia-Pacific region has also struggled after the American market suffered the worst day in nearly 2 months. Also, of course, waiting for that Federal Reserve rate verdict. And as we just talked about the US elections next week. Have a look at the pound. As we saw earlier, it is gaining some ground back on the US dollar and on the euro, while a barrel of crude oil is up a little bit after some statements from Iran, up by 1.66%. Okay, let's speak to Rachel. We're going to speak to her after a quick commercial break. We'll have the very latest on the markets next.
Weeknights on Sky News.
This is your chance. Tell people. Welcome to the Politics Hub.
Our police force has apologised. If you want to find out about Grimsby, you come to the docks.
I'm live in Jerusalem.
Are you not concerned that that could lead to all-out war?
Hello there, good evening. There are fears of an upsurge in violence. What's at stake here?
You are watching the press preview, a first look at the front pages as they arrive.
I'm Adam Parsons, Sky's Europe correspondent based here in Brussels. I've witnessed migration across Europe close up.
I'm James Matthews and I'm Sky's US correspondent based here in Washington, D.C. Mr. Musk, has your ignorance and ego cost Ukrainian lives? Free, wherever you get your news.
I'm Ivor Bennett, Sky's Moscow correspondent. Why do you support Vladimir Putin, Mr. Seagal?
I'm Connor Gillis, Sky's Scotland correspondent. Sky News, the full story first.
I say, bring it on.
With America divided and tensions running high, get ready for an election like no other.
Join our teams as we follow the campaign trail as America decides.
We will win, win, win. Get closer to the action this US election with full reaction and analysis.
Sky News, the full story first. Play Sky News.
From the Sky News Centre at 7.
Now that you're up to date, we can go into a bit more detail.
Things can change incredibly quickly.
Taken by surprise.
Have you ever known a moment like this in British politics before? Yes. Cheers. We'll start with breaking news.
Let's get the latest on the ground.
So, by the end, we'll hopefully all understand what's going on in the world just that little better.
Day of this conflict.
They keep telling us that they want aid.
And this is what's left of it.
Tanks, heavy vehicle.
Why only in America? People want their country to work.
They want to jump in a normal life.
Why are these homes empty?
I want you to be honest with people.
That has happened within minutes.
Sky News, the full story first. Free wherever you get your news.
Very welcome back to Sky News. We're going to just bring you up to date with some breaking news that's come in the last couple of minutes in regards to that flash flooding that we saw in Valencia in Spain. The death toll has now risen to 202 people have officially been confirmed dead in those flash floods. Clearly, the rescue operation is still underway. The alert across much of eastern Spain remains high, but authorities confirming in the last couple of minutes that 202 people have died, confirmed in that flash flooding in the Valencia region of Spain. Let's return back now to the budget, because among other things that Rachel Reeves has done is extend business rates relief for the UK's hospitality sector. The Chancellor announced a 40% rate of relief for the industry, which is down from the current 75% rate, which was set to expire at the end of March next year. However, industry figures have criticised the 25% cut, as well as the increase, of course, in national insurance contributions, and I'm sure the increase in the minimum wage. Well, let's speak to Marcus Teslev. He is the founder and chief executive of the Teslev Group, which owns 6 venues in London, with another one opening next year. So a mixed budget in some ways, you might argue, but there will be a lot more tax to pay.
Darren, thank you for having me on the show. Yeah, look, I'm a big fan of hospitality in the UK, and I think we are not thought of as much as contributing as much to the economy as we actually do. I think behind the rhetoric, it was all about fighting inflation and working on unemployment. However, my personal opinion and everything I'm reading is that it's going to have the opposite effect. Most of my peers I'm speaking to can't absorb any more costs. And there was a study out this morning by UK Hospitality saying that roughly they expect that each full-time employee is going to, in hospitality and retail, is going to cost another £2,500. So someone like ourselves, who've got 470 odd members of staff, and plus we offer a bunch of benefits like private medical insurance and a lot of charity work that we do. And, we're going to have another £500,000 onto our wage bill a year, and Marcus, which is not a joke.
Yeah, and just, we haven't got much time. I'm really sorry about this, but what does that mean then? Does that mean fewer jobs? Does it mean fewer restaurants?
Well, I think two things. It's going to mean that most operators are going to pass the prices on to customers straight away. So that's going to really create long-term inflation. And I think secondarily, on the unemployment side, a lot of people simply can't absorb these costs, and they're going to have to start laying people off. That's what I'm hearing. So I think it's troublesome because, look, at the end of the day, what do I know? I'm a restaurateur and a small business owner, but we're supposed to be, in developed economies, hiring most of the people. And I feel like the politicians kind of overlooked that this time around. I'm all about giving a higher minimum wage to everybody. I think that's very much needed.
Yeah.
I think the national insurance and the business rates relief isn't enough, and I think they need to really look at that.
Okay.
They also punish companies for being too
Yeah,
too
Marcus, we're out of time, but thank you for your input from Barcelona. That's it from me for now. We're back at 4:30 with Business Live. Up next, it's the top story, Steve.